What's up, audit fans? Dr. Amanda White here with another video in our Standards Explain series. And today I'm going to be looking at ASA 450, which is about how we evaluate misstatements identified during the audit. Now, this is sort of a strange standard to have in this particular spot. The reason that I say that this standard is in a bit of a strange place is that because our 300s are really all about that sort of planning and getting yourselves organized. The 200s are all about sort of basic premises of the audit. The 400s sort of seem to be this weird middle of nowhere place. You've got the 500s, which are all about collecting evidence, and then you've got the 700s, which are really the standards specifically on reporting. So if you're thinking about evaluating misstatements, I almost think that they sort of belong in here, in this sort of gap between evidence and reporting. Now, I know the 600s is the use of experts, but I almost, in the chronological setup of the standards, 450 sort of seems a bit out of place because it's something that we would do after we go and we generate our evidence. Our table of contents, nothing terribly exciting here for us to look at. We're going to have our requirements, that's our legal information. Here are the parts about misstatements. And then, of course, we always end up with our documentation. I'm going to talk a little bit about the explanatory material today, and I don't normally do that, specifically in terms of definitions of misstatements. That is often something that students are concerned about. What is a misstatement? So I'll go more into that definition. Of course, ISA, ASA 450, they're harmonized and they're the same. So if you're studying internationally, then this video is perfect for you. Digging into our standard, let's always start with our scope. So I'm going to zoom in a little bit here. So we have to find misstatements. That's our job. Our job is to go out there and we're looking for our material misstatements. As I mentioned in the video on materiality, which I'll link up in the top right-hand corner, we're not looking for the post-it notes or the toilet paper or the pens that you've stolen. We're looking at items that are material. So what are my responsibilities as the auditor? I have to evaluate the effect of those misstatements on the audit of uncorrected misstatements on the financial report. All right. So we have misstatements that we're going to ask management to adjust. So typically, you find a misstatement, you're either going to ask management to make an adjustment, or you're going to do nothing. And if you do nothing, you're going to have one of these uncorrected misstatements. Now, if you do have uncorrected misstatements, the standard is going to talk about what we have to do in those specific circumstances, because an uncorrected misstatement may in the future have some sort of flow-on effect in a future year. So we're not just thinking about this year, but we're also thinking about last year and future years. Paragraph 3 talks about our objectives. So my objective is to look at the effect of identified misstatements and the effect of uncorrected misstatements on the financial reports. Remember that we're always thinking about our users. Will this information change the decisions of our users? There's only a few definitions in this particular standard. So the first one is a misstatement is a difference between the reported amount, classification, presentation, or disclosure of an item, and the amount, classification, presentation, or disclosure that is required in accordance with the applicable financial reporting framework. Now, in most circumstances, that applicable financial reporting framework is going to be for Australian viewers, your AASBs, and for international viewers, your version of IFRS. If you're in the US, obviously that's going to be US GAAP. So it's the difference between what management report. So when it says reported amount, essentially that's management's report. All right, what they put in the unaudited financial statements and what we believe is the appropriate amount. So the blue one there is the amount that is going to be determined by the auditor. Because remember, what I have to do is I have to express an opinion about whether the financial report is presented with a true and fair view in accordance with the accounting standards or the applicable financial reporting framework. So it's our comparison between what management think and what we think the numbers should be. What exactly are the uncorrected misstatements? That's misstatements that the auditor has accumulated that have not been corrected. Now, they might not be corrected because we determine that they're immaterial. All right. So that's normally the reason, or so they could be immaterial or management refuse to make the adjustment. Because I can't actually force managers to change the financial statements. I can suggest what I think might be best, but I can't force them to make any changes. So let's start with the requirements. Remember, the requirements are the legally enforceable parts that I have to do. So I shall accumulate misstatements identified during the audit other than those that are clearly trivial. And you can look at the explanatory paragraph there for things that are trivial, but that's, the post-it notes and the pens. So typically what an auditor will have is they will have some sort of schedule of adjustments. So they'll usually have a schedule of misstatements that they find during the audit. They'll keep a list of what item, what account, this is how much it is. So they will keep a tally of that list from across the entire set of the financial statements. As an auditor, paragraph 6 says that I shall determine whether the overall audit strategy and plan need to be revised if I find that there could be material misstatements or that they could approach materiality. So if I find that I'm getting closer to materiality, or I've definitely found material misstatements, I might need to revise my plan. Now, how might I revise it? I might decide that I'm going to collect more evidence or evidence from different sources. All right. I might even need to change my audit strategy from a controls-based approach more to a substantive approach. What happens when I find misstatements? Well, I have to figure out how I'm going to communicate them, and I have to do that on a timely basis with the appropriate level of management. Now, if we scroll down here to that little footnote, 3 says, see ASA 260, those charged with governance. So the appropriate level is usually those charged with governance, that TCWG that you often see. In the majority of situations, that's actually going to be the audit committee. All right. Now, it also depends on whether you think that there's fraud. If you think a misstatement is due to fraud, you're probably not best to go and confront the person who is engaging in the fraud. Now, of course, I shall request management to make a correction, but they can refuse. They have the right to refuse. I need to understand why they don't want to make the correction, and then that's going to affect the decision on my financial report. And that's where I'll probably need to flick over to ASA 705, which is where I talk about my modified audit opinions, which is where typically management will refuse to make a change. And I've got usually two options. I could go with a qualified, or I could go with an adverse opinion, depending on the severity of the situation. Now, I mentioned earlier the effect of uncorrected misstatements. And these are the ones that we don't request. All right. So we have to assess, the auditor shall reassess materiality in accordance with ASC 320 to make sure it's still appropriate. Because remember, things may change over the course of the audit. I might discover more risk, and the materiality that I might set at the planning phase early on could change. So I need to think about, do I need to reevaluate it? Most times, if there is more risk, our materiality does need to go down. So once I've reevaluated my materiality, I have to look at, are these uncorrected misstatements individually or in aggregate material? So I need to look at the size and nature. Could this item be qualitatively material if it's not quantitatively material? Remember I mentioned earlier that I might have an uncorrected misstatement from last year and this year. What is the impact? And it says here, I have to think of the effect of uncorrected misstatements related to prior periods on the financial report this year. Because, and you might think, well, why do I need to think about last year if I'm only looking at this year? Well, if you had a $50,000 understatement in an account last year and in the prior year, and you decided that that was not material, okay? And then this year you have an $80,000 overstatement. That's the current year, which again, you might decide, let's say materiality is 100,000, you might say not material. However, what you do have is you have a difference between those two of 130,000. Then while each of these individually doesn't actually breach our materiality threshold, when you look at the difference of a $50,000 understatement to an $80,000 overstatement, your difference is actually 130,000. So you have to think about, well, it might not be misstatement this year, but if you combine it and look at the swing, could that be important? So that's often something that we don't talk about too much in the textbooks. That section of the standard doesn't get much airtime. Now, I mentioned before that we have to communicate with those charged with governance. If I think that there's any uncorrected misstatements, then I need to talk to them about it because they may have some sort of legal impact. Management may refuse to make an adjustment, in which case I think the audit committee should know about that particular issue. I also need to make written representations. All right, so where I have, remember before I had that schedule of all of the misstatements that I would take to management, I'd also need to provide that to them in writing. All right, I want to say, okay, here are the misstatements. Here are the ones that you've agreed to make changes on. Here are the ones you refuse to make changes on. And importantly, this is going to be the impact, whoops, wrong pen. This is going to be the impact on the financial report as a whole. All right. So you want to have that information included in a written format to the client, all right, typically our audit committee. Now that's important so that management can't come back later and say, oh, I didn't know, you didn't tell us, we have it written down. And that just sort of backs up our last item here, which is the one I usually do in the pinky color, which is the documentation. All right, so I have to document the amount below which misstatements are clearly regarded as trivial. So where is that essentially materiality level for a particular account? Sometimes it's also called some sort of threshold. We also have to document all the misstatements during the audit, whether they were corrected or not, and that's where that particular schedule comes in that I was talking about earlier. And then my conclusion, and then what the impact is also going to be on our audit opinion. The only section that I wanted to bring up was this one here about the definitions of misstatements. So what could they be? They could come from inaccurate gathering or processing of data, so that could be a problem with people or internal controls, something that they omit. And this is important. They say an amount, so it could be a dollar value or a disclosure, because remember, most of our reporting standards have very specific disclosure requirements. So failing to disclose is just as serious as failing to include an amount. They might have an incorrect estimate. We're going to look at that a lot more in, it could be an incorrect estimate. We're going to look at that a lot more in 540 moving forward. It could be a judgment of management about estimates. So these two tend to go together. Usually that's something difficult like intangibles. It could be an inappropriate classification of information. So again, this is in the reporting and disclosure component of the financial statements. And then the last one, which is a little bit unusual, for a financial report prepared in accordance with the framework, the omission of a disclosure necessary for the financial report to achieve fair presentation beyond disclosures specifically required. So that means sometimes you might have to go against the standard to make it true and fair. It's very rare, but there is that possibility. So those are all the different places that we might have misstatements. Now, some of these, you've got the possibility that there could be intentional manipulation, all right, or it could be the accidental error when it comes to misstatements. Well, that's it for ASA 450. I hope you found the video useful. I'd really appreciate a thumbs up. Please consider subscribing to keep up to date with all the latest audit and accounting news. You can find me on social media. I'm on Twitter, I'm on Facebook, as well as here on YouTube. If you have any questions, please pop them in the comments. I always love hearing from our viewers, and I will see you in the next video.